Hello and welcome to a brand new show of Market Makers. Whereas markets are trying to adjust to the new normal both locally and globally, a variety of factors currently are at play. Globally, hope that US economy will make a comeback is fueling developed market equities. Locally, there is a strong rally in the bond market with the assumption that local interest rates in India will come down substantially and very strongly. But markets, some would argue, they're finding it slightly difficult to readjust to the new normal. One side you've got flows out of emerging markets, and then domestically there is going to be pressure on consumption at least for a quarter or so. So how should one read into the current reboot or the reset? To discuss that and to understand that, I have a perfect guest with me, real market veteran, Sukumar Rajah, Managing Director and CIO, the Chief Investment Officer, Asian Equities with Franklin Templeton Investments. Sukumar, welcome to the show and thank you for joining us. Sukumar, we are staring at interesting times. Both locally and globally things have got reset. So let me first start with your understanding of the global environment. What do you think could be implications of a Trump victory on emerging markets?
Nikunj, first of all, thank you very much for this opportunity to speak to your viewers again after quite some time. It's my pleasure. Yes, things have changed quite a bit. The Trump agenda is quite different from the current establishment in the U.S. So Trump is a very different type of a person, and he has made certain election promises, but clearly all of them are not deliverable. So I think he has to focus on a few things, and there's still clarity not emerging about exactly how he is going to go about focusing on some of the agenda items. On trade, I think is what there's a lot of nervousness, because he has taken a very anti-trade stance during the elections, and also some of the appointments are considered to be hardline people. So there's going to be a little bit of a volatility in the sentiment, as there's going to be more noise that is generated on trade, and consequently, some of the emerging markets which are exporting substantially to the U.S. Might get impacted in terms of sentiment. But we do not think that this issue is going to be longer lasting, because a lot of products that are produced in emerging markets cannot be economically produced in developing countries like US. So we do not expect a large-scale shift of the manufacturing base from some of the emerging markets into the developed countries. But nevertheless, when there is going to be a lot of talk, I think there's going to be some nervousness, which is going to increase the volatility of the markets. So I think that's one. And the second is, of course, the China-related issues have been postponed, but the solution has not been found yet. So the imbalances in China continue, and at some point of time I think they have to deal with that, and that could also create certain amount of volatility in the emerging markets, and especially on commodities. The commodities have rebounded, but we are not probably seen the last word spoken on that subject, and I think there can be some more challenges in 2017 if China is going to scale down on the property sector and investments in some of the infrastructure sectors as well. So all in all, we think that there are some positive factors, like for example, I think the emerging markets margins having stabilized. We are seeing quite a few upgrades in terms of earnings, and the companies are generally pretty resilient. Valuations are extremely supportive. So we see a lot of positives, and we see a lot of value in emerging markets. However, I think the news flow, particularly in US, in China, and potentially in EU, if some of the elections go in terms of the writers. Those things can cause further volatility in emerging markets. But we think that every dip is going to be a buying opportunity because of compelling value that is available today.
Sukumar, the construct of the world post 2008 has been central bankers were following a loose monetary policy. Growth numbers in the developed world were not strong, and de facto global money moved into emerging markets. If indeed US economy has to make a comeback, do you think you may see serious outflows in emerging markets, because emerging markets are struggling? Each emerging market has its own challenge, and frankly, Sukumar, emerging markets have not also given very mouth-watering returns for global investors in last couple of years.
We have seen flows actually out of emerging markets in the last few years, and clearly emerging markets have underperformed the developed world. While I think the margins in some of the developed countries, particularly in US, are pretty high compared to the historical highs. The margins in the developing countries, the emerging markets, are pretty low compared to the long-term average. And we think that can improve, and so in terms of earnings growth potential, I think emerging markets potential is much better. On top of it, the valuation discount is also pretty high compared to developed world. So all these things make us believe that while there might be some volatility in emerging markets, they present compelling value and should outperform in the medium term.
Sukumar, within the emerging market, if I look at the India appeal, India's classification has been premium, and India's economy currently promises a better future ahead. But despite the underlying big picture argument, India is underperforming emerging markets. Why is that happening? And if this continues to happen, will that create more pressure in terms of India allocation, and do you think outflows will start? Because we've seen massive outflows already in the month of November.
We do not believe that's going to be a longer term issue, though from a very short term point of view, some outflows are possible. We did see the India underperform, mainly because India had outperformed earlier, and some of the other stocks in other emerging markets were beaten down to pulp, and when people realize that things are not deteriorating, and many of these stocks are extremely cheap and undervalued, I think there's been some money flowing into some of those names. And also there were some factors in countries like Korea, like improvement in corporate governance or potential improvement in the restructuring of the chaebols and so on. I think these factors also aided some of the companies in those markets. But from a longer term point of view, India is pretty well positioned, because apart from structurally higher growth opportunity, and there's also going to be a margin improvement story, because margins are pretty low compared to long-term average. We have seen the margins sort of stabilize, and we could have seen some improvement, but there have been some local factors which have also postponed the improvement, but we do not have any doubts about the potential for improvement over a period of time. And so we think India will continue to be a market which will attract a lot of inflows, though there might be outflows from a very short term point of view.
What is the right way of assessing the demonetization impact, Sukumar? Because we can argue the event adjustment both ways. In the short term, economy will get jammed. In the long term, this is positive. But from a market standpoint, from an economic standpoint, do you think it's very difficult to decipher the real assessment or the real impact?
Yes, I think there are too many moving parts. So I think it's right to assume that in this quarter the growth will be severely impacted because of the lack of cash. I think a lot of economic activities had slowed down. or come to a standstill for a brief period of time. But beyond that, I think it's very difficult to say what will happen. I think that there will be classes of people who will also benefit from this, especially the lower income category and the middle income, and I think they might actually increase their consumption, whereas a lot of products that were bought by people who had a lot of black money, like jewelry or some of the luxury goods or luxury automobiles, and to some extent high-ticket real estate, might get negatively impacted. So there are going to be some categories which are going to see improved growth and some categories which are going to contract. So I think it's very difficult to make take a uniform view on all categories, and how they will play out and the time frame. Again, it's quite difficult to predict at this point of time.
So after the two reboots, the Trump reboot, which is global in nature, and the demonetization impact, which is largely local in nature, what will happen to your portfolio positioning? Because the world will change and the environment will change. So are you looking at reassessing some of your key holdings, your key positioning?
I think thanks to the robustness of our investment process, we don't have to do that, because when we buy a stock, we are looking at the quality and sustainability aspects of the companies that we buy in. We do not have much of ownership of companies where I think the prospects will change because of the change in the environment. We are looking at buying companies which offer products and services which are very competitive from the customer's point of view, and there's a room to keep growing for a long period of time. And so our portfolio companies, we don't see them getting their longer term business getting affected. Of course, on a 1 quarter basis, I think many of these businesses might get affected, but that doesn't warrant a change in the portfolio. So we are pretty happy with the robustness of our holdings.
What is your assessment of the banking sector? For the banking sector, Sukumar, it's difficult to understand the environment. Interest rates may be coming down, but lending activity is still under pressure, and most of the banks, at least the retail banks, they fear that because of demonetization there could be uptick in collections and NPAs.
When we are buying Indian banks, the current year's earnings is a very small proportion of the total value or the price that we are paying for the banks. So the bulk of it is in the longer term earnings or value creation, and that story has got much better. If the black economy is going to reduce by whatever percentage, some could argue it's going to be 20%, some would argue it's 40%, some would argue it's only 10%, but whatever it reduces by, I think is going to improve the the economics of the banks, because I think more of the money is going to go into the banks rather than be kept as cash, and that improves the opportunities for the banks to create value. And the banks that we are holding are pretty dynamic, and with a changing landscape, I think their managements are well equipped to get a higher share of the incremental business that will come because of the changes in the system. And we think it will only improve their longer term value proposition. And so while it's very difficult to put exact number to that, but clearly I think the direction is very favorable.
What is your view on IT? You talked about durability and sustainability. Now IT companies are good, well-run companies, but the environment is changing. The IT business per se is contracting, and there is every reason to believe that in the short term, because of the change of IT service offering, the pain is here to stay. So do you now worry about the IT sector, Indian IT sector per se in terms of longevity?
Our job is not to worry. Our job is to make a right assessment of the situation, and I think we have discussed in many of your programs earlier over the last 3 to 5 years, and our view has consistently been that the market is trying to extrapolate the past into the future, and our view has been that the rates at which these companies were growing were not sustainable, and also there could be margin pressures for a period of time. So the arguments we have been making over the last 3 to 5 years is that the market share of Indian companies has gone up within the total outsourcing market, and the total outsourcing market itself has increased in proportion to the total IT spending. Because of which, our growth will gradually converge, the growth of our IT companies would converge towards growth in total IT spending over a period of time. And those type of projections have already been factored into our target prices. So what has happened in the recent past is very much consistent with our modeling of how the growth and margins will trend, and so we have not had too many ugly surprises. In general, our weights have been lower compared to the benchmark and many of our peers, and the reason for that is not because we didn't have trust in the IT company. It's just that how we model growth and margins is quite different from how the market has been doing so.
Sukumar, let me throw in the good part here, and the good part here is that Government of India's balance sheet will improve, interest rates will come down, and inflation, in a sense, which was largely a function of a combination of parallel economy and the real economy, is going to see a reset. Now these are big structural changes, Sukumar, which will happen in India post-independence. So from a market standpoint, how should one capitalize on these mega trends?
I think one way is to have a higher weight to equities, because clearly I think if the interest rates are going to come down and also equity risk premium comes down and the margins expand, which means that the stocks have multiple levers to generate good returns for the shareholders. So clearly that's one way of looking at it. Second is, I think in India, I think it's very difficult to generate good real returns out of low risk categories perpetually, because it's a young country, and I think there's going to be more risk appetite, and the low risk categories are not going to generate very good long-term returns. So I think people have to look at other areas of investing other than the traditional investments like bank deposits.
Sukumar, what is your understanding of domestic flows? The good part of this market has been that whereas foreign institutional investors, they've been selling and they've been trimming their exposure because of ETFs and other compulsions, domestic institutional investors have been firm like a rock. So in this market decline, were you a buyer, and do you think there is enough and more visibility about flows for next couple of quarters?
I can't speak for the domestic institutions as a whole, but conceptually it's like this. The equity mutual funds are there's not much of cash, so the buying and selling depends on whether the flows are going to be there from the underlying investors. And so far, I think the flows have generally been positive, though it's varied from time to time. And we have reason to believe it will continue to be positive, because the penetration of equity products is so low. I think it has a lot of room for improvement, and more investors are better educated, and are putting money on a periodic basis into equity products. So with flows into equity funds, I think the mutual fund should invest more into the market, and obviously the job of the portfolio managers to look at what are the best stocks to buy, and very few of them within Franklin Templeton, definitely none, and even outside I think there are very few people who are actually timing the market.
Okay, Sukumar, let me get closing comments from you. What I've always admired about you over the years is that your ability to pick up big profit pools and your ability to look at these big profit pools which are sustainable in nature for 5, 10, 15 years. You identified IT sector in 90s. You identified private banks also right ahead of the curve. So if you have to identify a multi-year, multi-decade opportunity from a stock market standpoint where you think great companies will be born and those companies will be able to scale up and the profit pools are large, what would be that 5, 6, 7 year opportunity?
So we have to look at, because of the transformation of the economy, some of the untouchable sectors earlier, whether they are becoming touchable. There were some sections of the economy where black money dealing was very high, and companies which were in those sectors, they were less transparent, and there were more corporate governance challenges. If those type of sectors are available for clean businesses, then that could be an opportunity that we have to look at. That's one. Second is, of course, there are new business models emerging because of change in technology, e-commerce and payments and number of other areas. So I think that's that would be one driver of some companies to or some business models to outperform substantially compared to others. And of course the other theme is going to be the growth in middle class population is going to be one of the fastest for the next 15 to 20 years. I think we are going to add many more people into middle class for the next 10 years than we ever added. And then we need to look into where I think the new middle class is going to spend the money, and which categories are going to benefit. These categories can see structural improvement in their growth, and the growth is not going to go to all the players. There are certain players who are going to be better equipped, and so we are looking at all those things. We can't speak about the names because we can only speak about the names where we are already invested and they are top holdings in our funds.
One more closing comment, Sukumar. Do you think 2017 would be marked with a lot of volatility because a lot of resets will happen? The demonetization impact, Trump will officially take over, and then you will somewhere see the GST adjustment in the economy. So rather than being optimistic, is it better to remain cautious at least for a year or so, because you don't know which way the winds are going to blow?
So we for making such decisions, what I would look at is what is the implied equity risk premium. I think if the implied equity risk premium is very high, I think it gives us comfort that many of these uncertainties have already been factored in by the market, and so we are buying stocks at with a good margin of safety. And looking at the current data, we believe that there's a lot of margin of safety, and I think my view is that people are better off with stocks with all the uncertainty, and will regret if they don't have adequate equity exposure, because when some of these uncertainties lift, I think the rebound will be so strong that it will be very difficult for a lot of people to get in at the right time.
Fair point. You always have to buy ahead of the curve, and equity investing is all about long-term allocation. Sukumar, fantastic to have you on the show. Thank you for joining us. Glad you could accommodate this interview request.
My pleasure, Nikunj.